Today on the final bar, we'll talk market stability, market holding steady from yesterday's close, but defense leading the way. Utilities and real estate at the top of the list. Not shockingly, energy there at the bottom. So we'll talk about what this means. What do you have when semiconductors are doing well and utilities are doing well at the same time? We'll break down some of the charts. Also hear from my guest, Chris Brecher of Brecher Trading, sharing a couple of his stocks around earnings that are actually interesting plays to think about. That and sector setups as well. Ladies and gentlemen, this is the final bar. Everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the bell to deconstruct what happened in the markets from a technical perspective connected to the long-term trends. It's so easy to get caught up into the short-term fluctuations, the short-term news. And I would caution you, as always, don't pay too much attention to what happens on one particular day. Think about a series of days that goes into a series of weeks, the longer-term trends. That's where, arguably for long-term investors, that's where the real alpha is generated. That's where the real long-term money is made. So, today we had an interesting fluctuation with stocks actually falling down a little bit, closing in a position of weakness. Utilities and real estate, though, had led for most of the day. So we're going to think about what that means from a sector rotation perspective. Is it still tech leadership? Is it more defensive rotation? What does that mean for the broad equity index performance? All of that we're going to dig into here today. Some really interesting stuff coming up on StockCharts TV and on the final bar in the coming weeks. Just wanted to highlight for you our new show, Behind the Charts, just premiered this week with our interview with Tony Dwyer. Next week, we're going to feature a conversation with Eric Balchunas. Eric is the ETF analyst at Bloomberg, based in the New York area, and we had a really good conversation with him about ETF construction, what it means. You're not going to want to miss it if you invest in ETFs, which I know most of you probably do. We also have Jim Smith, who's an expert in GAN analysis, Leslie Juflas, who's the author of Trade What You See. And then on the 20th, we have Sam Burns. He's at Mill Street Research, a successful sell-side careers in the Boston area. Week after that, we're actually going to be on the road. Final bar, we're going down to Houston, speaking to Texas A&M University. So we'll be working up some really interesting content for you for that week. Also, just real quick, we had our first YouTube live Q&A. We are going to do another one next Thursday, so make sure you go to our YouTube channel, subscribe, hit notifications, and you'll be aware when we jump on and start answering your questions on YouTube. Let's get into our market recap. So as I mentioned in the introduction, quite a volatile day, and it was not a clear, bullish or bearish trend. There were moments that felt fairly constructive. There are moments that felt a lot weaker. There's no denying that the equities finished in more of a position of weakness, with the S&P going down in the last hour of the day. And again, it's very generally speaking, but that last hour is when big institutions and ETFs have to do, rebalancing. Any big moves they're going to make, they do at the end of the day. So that sometimes will tell you sort of that bias, sort of what they're going to be doing. Here, essentially more selling pressure than buying power, more supply than demand, and that's what's pushing the markets lower into the close. Mid caps up a little bit, small caps up even more. So you have this day that felt a little more negative, but with small and mid caps actually finishing in the green, which is a different take than we've had for a while. The really interesting thing, though, this is why kudos to my producer for putting sector rotation today, sector setups, because it's exactly what comes to mind here. You have an up day, finished a little weaker, but overall not too bad, and we held it very nicely. But the Utes and real estate, number one and number two. Consumer staples was up here in the second for a little while, but finished third place. So 1, 2, 3, all very defensive sort of areas of the market. So it's not sort of the long and strong feeling we've had before. Industrials at the bottom today, followed by healthcare, then materials and energy. So the MEI trade is the materials, energies, industrials. That's sort of the late cyclical leadership, all in a position of weakness. And tech finishing down on the day. So, quite a mixed bag where you have some strength, some weakness, but in some unusual places, maybe some unexpected places. Let's look at what this means for the long-term trend. Let's look at a chart of the S&P 500, and then we'll get to some other themes that we saw today. So the S&P obviously closing a bit higher from the open, but below yesterday's close. So that's sort of that middle of the road, feeling okay during the day, but really coming off into position of weakness. So not going negative, but not really holding up in a super positive way. But the long-term trend remains very constructive, right? This is a little bit of volatility in the context of a long-term uptrend. We had a higher high today. That's a new all-time high. That happened. So again, plenty of area below where we're at, down to the 50-day moving average around 3250. Below that, 3210 has been the line in the sand. So as long as we remain above those levels, even with that, that could be a meaty pullback, but it would still be within the context of an uptrend. So overall, trends certainly remaining very positive. Yeah, I thought it was interesting looking at the ETFs today. Only one of them was up on the day. It's the Frontier Markets FM, which is a relatively illiquid ETF, and it has plenty of liquidity, but not anywhere near something like the Spiders or the Diamonds. And also, it's a pretty narrow exposure to Frontier Markets. It's a lot of banks and a lot of a couple particular countries have exposure there, just because Frontier Markets, by definition, have relatively underdeveloped exchanges, underdeveloped liquidity, but most things, finishing in the red today. On industries that were up, automobiles number one. I would say that's probably, I would guess, driven primarily by Tesla. Would be my guess. We can look at the chart of Tesla here. Yeah, so Tesla actually finished up pretty well, right? Almost 5% up, which I had that sense earlier in the day. It's once again back to that overbought range. Tesla's had so much volatility, and I forget when we looked at this, but just this narrowing of volatility. I think this was yesterday, right? You have these lower highs and higher lows after that big spike higher. And the question is, which way do we resolve? We've arguably resolved through the upper end of that, sort of coil pattern of lower highs and higher lows. I think we'd have to see tomorrow if we follow through. Some of you might say this is a bullish engulfing pattern, and, based on the pure definition of it, you're right. But what you have to remember, all my mentors that were big candlestick experts, Steve Neeson is the one that comes to mind that I spent time with years ago talking about candlestick analysis when I was with Bloomberg. He always said, look, a candle pattern is only as meaningful as the trend leading up to the pattern. So a bullish engulfing pattern has value if it comes within the context of a downtrend. That suggests a change of characteristic. This, a little less meaningful because it's coming out of more of a consolidation pattern. So I'm thinking more about these, the triangle that we're seeing, the coil with something like Tesla. I also noticed airlines on there, and it's interesting. Something like Alaska Air Group is an interesting chart, and interesting is the word I have to use. I can't say overwhelmingly positive or overwhelmingly negative. It's sort of a meh chart, but is intriguing to me, and I'll tell you why. We have an increasing 200-day moving average slope, right? So it's kind of coming up. We've tested that a couple times. It's arguably just bouncing it. Broke below, but did not confirm it. Sort of turned right around. Now it's testing the 50-day moving average from below. If it breaks back above there, that would be fairly constructive. And then all of a sudden you see this as a nice run and more of a bull flag pattern, lower highs, lower lows, but it's a pullback within the context of a longer uptrend. The two things I would look for, number one, is the RSI able to continue higher, make a newer high there. More importantly, is the relative strength start to improve. And if you connect a trend line using these peaks and the relative strength, we'd have to get a little bit further for that to follow through. But if it does, it could be interesting to look at some of these airlines that are buying in on a position of weakness. Sort of that, my sort of base case, the fat pitch chart is a long-term uptrend, 1 month weakness, which means it's weaker in the short term, but longer term, fairly constructive still. So Alaska Airlines, ALK, is an interesting chart that I'm wanting to pay a little bit of attention to. I want to move right on to our next segment, which is sector setups. So the idea with sector setups is really threefold, in my opinion. Number one, I like to look at the relative rotation graph, the RRG graph. Look at how these sectors are rotating around a benchmark. Number two, look at the candle glance pages, which shows you all 11 S&P sectors at once, so you can start to make some relative comparisons that way. And then number three, look at some of the individual sector charts and think about what they mean. And hopefully along the way, we'll answer some questions about sector rotation and leadership and laggardship. So I want to start with the relative rotation graph, the RRG, and I'd remind you, we never have enough time on this show to really dig into the mechanics of some of these visualization tools, but if you're not familiar, Julius de Kempener has a show called Sector Spotlight, which is really, really well done. If you go to our YouTube channel, you can see his replays, and he walks through this in a lot of detail, does a really good job. I've followed his work for many, many years, and it's been one of my go-to ways to measure sector rotation. What strikes me looking at the RRG, if you are familiar with it, is that the XLK has been the consistent outlier in a position of strength, right? So up and to the right, heading northeast is a position of strength. Heading southwest is a position of weakness. This is why the XLF and the XLV look so negative, I think, based on the weekly RRG, because they had been strong. They had been in the leading quadrant. They're now in the weakening quadrant, but more important to me is that they're heading southwest, which means decreasing momentum and decreasing relative performance. It's not a good sign. What you want is things that are more heading northeast and improving, which is what we see with the XLK. I think it's really interesting to note that maybe the most improved award would go to something like the XLU, which had been way down here in the lagging quadrant, has rotated northeast, and is now in the improving quadrant. So in a pretty interesting position. Also the XLY, I'm a little hesitant with that, probably because of Amazon is such a huge weight in there. So you have one stock that's dwarfing a lot of the others. So if that one stock does well, the XLY will do pretty well also. But worth noting, totally fair, if you buy the XLY, that's the return you're going to get. And it's similar to the XLU. These are two sectors that are actually improving very much on a relative basis. The communication services sector, this is about what it feels like. You can see it's sort of chopped around. Look at these huge movements from healthcare and financials, huge movements from utilities. Look how XLC looks like it forgot to move for the last month. So if you think of the chart of the XLC, which we'll look at in a minute, communication services has done okay on an absolute basis, but hasn't done much at all on a relative basis, sort of flatlined on a relative strength model. And what that means is you're not really getting paid to own it, right? Owning the XLC is pretty much like owning the SPY, and it's a lot less stressful, I would imagine, because you're not exposed to a particular sector and their particular business model. So we'll look at that chart in a minute, but I did want to point out there's a reason why this is very close to the zero line, and it's not moving a ton. That just tells you from a relative strength perspective, it's not really giving you much to work with. Also, the XLE has been weak and continues to weaken, and again, based on that methodology, not much there to get excited about. Second thing I'd like to do is look at a high level using the candle glance page. So this is looking at the 11 S&P sectors and then the S&P at the end. And what I like to do here is just sort of take a step back and see where things are at relative to their moving averages, see what's breaking to new highs, what's breaking to new lows, and look for outliers. Look for what does not look like other sectors. So my first reaction looking to this, probably you can see a similar thing. Most of these things are actually fairly constructive, right? Almost all of them are above their 50-day moving average, and almost all of them have an upward sloping moving average. The one exception to everything I just said is the energy sector, which is right here. So it's actually going down. It's testing, all-time lows. It looks a lot like the chart of oil, right, which or the commodities ETFs, which are, relatively weak. You're betting on mean reversion if you're buying something like the XLE right here. But overall, from a trend-following perspective, not a lot to get super excited about. You compare the chart of the XLE with something like consumer discretionary breaking to new highs above two upward sloping moving averages. That's pretty good. So, when you think about sector performance overall and whether or not you should be positive about the overall market environment, the fact that almost all of them are in an uptrend by any of those definitions I just said should make you feel pretty good about the overall strength of the S&P 500. Now, again, this is not showing you the cap, right? So certain sectors have a huge impact. So something like discretionary is a big weight. Technology is a huge weight. It's the largest. Financial is pretty big. Something like materials is a rounding error. It's like 2 or 3% of the S&P, I would guess. So some of these have more of an influence than others. But I did want to point out the defensive side of the ledger actually looks pretty constructive. That, not that it's a concern, but I think it's interesting that something like utilities is doing so well at a time when the market is doing so well. We had our YouTube live Q&A this morning, and one of the questions we got related to leadership, performance of utilities and real estate versus semiconductors and technology. How does that jive where something very offense and something very defense is kind of working at the same time? And, my point is the rising tide tends to lift all boats. So when the market's doing well, pretty much everything does well on a price basis. That's why I think the RRG or the relative strength lines, both of those are really important because it shows you how these things are moving, not just on a price basis, but on a relative basis. Are you getting paid relative to a benchmark to own these particular sectors? I would argue something like the XLU back here in November, December was essentially flatlining. It was sideways. You can see the bounce that it had in the beginning of the year when it was rallying, but it was rallying more than the S&P 500. That's tapered off a little bit as things like technology have gone vertical, Tesla has gone vertical, and utilities have kind of held off a little bit. But overall, sort of holding up pretty well on a relative basis, still in pretty decent shape. You're up probably 5% owning utilities, depending on where you start the clock, but probably 3 to 5% from the end of December, which isn't bad. And that includes the total return components. That includes the dividend component. The real estate index looks a little earlier on. So again, if I just look at my idealized chart, right about here's pretty good. The end of January on real estate, we have this nice rounding bottom test of the 200-day. You pulled back just a little bit, call that a cup and handle pattern of sorts. Kind of a nice breakout, a nice break above resistance. As long as this remains above 40, that's in a very constructive place. And you've had higher highs and higher lows. It's overbought, but that's okay. That just means it's gone up a lot. And if you look at the relative strength, it's actually just starting to break out potentially. If it goes just another couple points higher, this is going to be a new 3-month relative high in the relative strength at the bottom, which would mean not only are you getting paid on price, you're getting paid for the overall performance as well. Now with tech and with some of the sectors, you have some challenges with being relatively extended. This is the chart of the XLK, and you can see it's just essentially gone, just been very, very strong up and to the right. No basing patterns like you saw with Utes in real estate. It's just been going sort of long and strong up and to the right. And you can see the relative strength sort of supports that. So the question was something like this, is when is that going to end, right? When do you get to the point? They always say the trend is your friend unless it's going to end. So knowing when we get to the end of that move is really key. And what concerns me with something like the XLK is the same thing that concerns me with the broad S&P 500 is this bearish divergence. Higher highs in price, lower peaks in the RSI really has not broken that and gone higher. It has not become overbought, suggesting potentially that we're at an exhaustion point, that we've gone too far. But again, for me, as long as something like the SMH continues to do well, making new relative highs overall, you can feel pretty confident that stocks are still in a position of strength. So that's our overall sector setups for today. And again, I tend to go 3 steps. I like to start with the broad relative rotation graph, look at rotation. I like to go into the candle glance to think about how those sectors relate to one another on a price basis, and then look at some of the individual charts. We didn't get to things like financials and others, but I tell you a lot of those have some things you should think about, especially in the financials where you have insurance looking much better than something like banks. What does that mean for the broader S&P? We're going to take a quick commercial break, be back with my guest, Chris Brecher. So we'll see you in a minute.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hey everyone, welcome back to the show. Thanks for joining us every weekday on the final bar after the close to deconstruct the day's trading from a technical perspective and link it to the long-term trends. Keep your questions and your feedback coming to us at the final bar at StockCharts.com. We'd love to answer your questions in our final bar mailbag later this week. I want to move right on and bring on my guest. Chris, are you with us?
Yes, I'm right here.
So Chris, and it's Brecher, correct?
Brecher.
Brecher, Chris, sorry about that. Chris Brecher from Brecher Trading is joining us. He sent 2 charts ahead of time, which were visually appealing, but very interesting because they're dealing around earnings, which were, so I'm very interested to hear what you have to say first about Zoom, ticker ZM.
Yeah, thanks for having me on, David, by the way. I think it's sort of a forgotten art of how to play these IPO lockups. So what happens is last year you had Zoom, you had Uber, you had Lyft, you had a ton of them. What happens is insiders usually can't sell until 6 months after the IPO lockup. So the first thing I look for is how much can they sell? So something like Zoom, they didn't issue that much in the IPO and the insiders could sell a lot. Like you see on the chart here, this is sort of amazing. The exact day to the IPO lockup was the low of the move, right there. That
right.
was the exact low, exactly 6 months. Usually it sells off prior to that because traders are positioning for insiders dumping it. So as you see, it worked. But there's another reason I brought this up, is a lot of times while traders anticipate the lockup, almost every single earnings that come out, the stock opens up and then sells off because people are anticipating the lockup. So that's what happened every single earnings in Zoom, everyone in Uber, and so on last year. And just to let you know, if you look at almost January 1st, we actually turned around and started buying Zoom because it was out of the lockup. And also tax loss selling is over by then because these stocks closed almost on their low for the year. So on the one hand, you had good stocks. I mean, they're great stocks. Plus you see in December to January 1st, you see the bull flag in Zoom. So I try to combine it with more than one reason. So you see that little bull flag on a daily. So the second that broke over 68, it was just free sailing to buy it.
So at this point, Chris, it's sort of round tripped, right? It's come back to the peaks from the beginning of September before it really fell out of bed. Where do you see it going from here? Do you sell into resistance, or do you how do you approach it here?
Well, that's a tough call because we were just playing it to the resistance. So we were playing it to that area, and I know it looks like a possible bull flag, especially with that the diminishing volume from the spike, but I just think there's a lot of people that were stuck up there, and I got to think there's too much resistance. If I start seeing a reversal signal on a daily chart, we'll turn around and short it. But right now, I'm not sure. Just in here, this is where we took profits and just went to another stock.
Right.
So the Datadog's fascinating. Datadog did something a little different. Look at the share float and the shares outstanding. So that's how much they can dump after 6 months. The thing is, though, they had a little thing in their SEC filing, which you can just go on internet and find it, that 3 months after the IPO, the insiders could sell 20% of their stock if the stock was high enough. So the stock was 33% above the IPO, so they unlocked about 60 million shares. If you look in there, look when the stock started to go down. It really went down around Thanksgiving. And it sold off almost to the day of when the insiders could sell that 20%, December 10th. So you'll see that little reversal candle on December 10th. It's fascinating. That was the low. The reason I'm bringing it up, you see that candle? That's so cool. So actually the reversal candle, that one was December 11th. So the day after insiders could start selling. But the point is traders were positioning for 2 weeks, anticipating that dumpage. So that was something that they could just see in SEC filing. The reason I'm bringing it up, it's a huge battleground stock. If the stock went down 10 points from Thanksgiving to December 11th, 10 points on a lockup of 20%, what do you think it's going to do when they have the other 80% unlocked on March 18th? So, I mean, that's a tremendous amount. That's over 200 million shares. So the deal is, when it has earnings today, if it had amazing earnings, you got to short rallies because it's probably going to reverse after market because everybody now is going to anticipate the next month of what's going to happen at the end in the middle of March. So
it's
sure enough, the stock,
I can't
stock
help
went
but
over
notice
50.
with Datadog, it's actually hit the big round number of $50 a share, which a lot of people would key in on, right? It gets to the 5 handle there at the very top. That's a big move relative to where it started here.
Yeah, well, that's another thing is, you got to think insiders are thrilled. So it's like I said, the last time it went down $10 on just 20% could be unlocked. It's a big battleground stock. Anytime I've ever posted that this could happen, I get so much hate posts. So I just wanted to reserve it for you in here. But basically, this afternoon, I shorted some at 49 after the earnings, right before I got on, and I'm already out at 46. So I made 3 points, but theoretically, and I just traded tiny.
Yep.
I mean, just tiny. But theoretically, it could go down for the next month. So there are a lot of ways to play it. You could short stock. I think you could buy March put spreads that include the insider lockup. So the March options expire a day after the lockup. And like you see, usually by then it bottoms. So
Chris,
a lot of times
two
you can
fantastic charts. We have to move on, but thank you so much for talking through both of these. And we recently, I don't know if you noticed, we recently added fundamental data, including earnings dates, and you're reminding me the importance of having an awareness of some of these key dates with IPO lockups and other things. Clearly, there's potential to move stocks if you're aware of them. So, Chris, thanks so much for coming on the show. We look forward to having you back again soon. All right.
Oh, thanks for having me on.
Folks, that was Chris Brecher of Brecher Trading. Really appreciate it. Two beautiful charts and two interesting discussions about the importance of being aware of those IPO lockup dates. So thanks, Chris, for those examples to talk through. We need to move on to the end of the show. This is the 3 in 3, ladies and gentlemen. This is where we look at 3 charts in 3 minutes. And if you're not familiar with these up until now, I hope they're on your radar from here on out. Our first chart is looking at the AAII ratings. This is the bullish and bearish vote that individual investors can make. It comes out every Thursday, so we just got a new reading today. And what I think was interesting is that it's very much leaned towards the bulls, which is not surprising because we've had a nice rally in the market, a nice move to new highs, a lot of good leadership stories, and it's not surprising. However, the severity of the shift, I think, is pretty meaningful. So last week it was almost dead even between bulls and bears, and actually favored the bulls just a little bit. So more bearish respondents than bullish respondents. Here we've actually increased over 40% of respondents bullish now on stocks, and 26%, 26.5% or so negative. So that's a 15% lean toward the more bullish side. So we're back up to where we were back here in mid-December when the market was going to new highs, sort of long and strong going into the end of the year. So the question with this always is, what does that mean, right? Are people so bullish, so overly bullish that some sort of pullback would be very disruptive? People would be caught on the wrong side of it. That remains to be seen here, but noticeable that it leaned very much toward the bullish side this week. Real estate is the second one, the XLRE. In our sector setups segment, we talked about this issue or this phenomenon where the market overall is holding up very nicely, but you're seeing really good moves in utilities and real estate. The real estate index in particular has been compelling because you see this cup and handle-like pattern. It's resolved to the upside. That usually measures a lot further up, and the relative strength is actually starting to break out. So you have a situation potentially where stocks overall are doing very well and real estate is outperforming. That's happened before, and it can happen again, but it's something that I think a lot of people would be unprepared for, and that's why I think it's an interesting theme to be following. The third chart of the 3 on 3 is another sector story. We didn't get into consumer names too much when we were talking about sector setups, but I think it's interesting to see how well consumer discretionary has done, driven in no small part by the strength of Amazon. But when you look at the consumer staples sector, it's actually looked very, very good. And my question to you is, if you looked at this chart and you saw it going up from 46 up to 65 over a 1-year period, would you feel good about that? And I can't imagine you wouldn't think that feels pretty good. That looks like a nice return. But here's the problem, is if you look at the relative strength. So in the last quarter, you've given up a lot. You were up 4% on the S&P for a little bit there, and now you're down almost 5%. So that swing has been during this period when, even though consumer staples sort of based out here in October, November, broke out and have been in a nice consistent uptrend, you just haven't been paid on a relative basis. So if there's one takeaway I hope you digest from today's show, is thinking about relative rotation in the form of relative strength and the importance of paying attention to relative strength. We get so caught up in the absolute prices, looking at whether something's in an uptrend or downtrend. On my checklist of indicators, my 7th and final step is to look at the relative strength. And if the relative strength line is going down, you're not outperforming. And Tom Boley, a fellow StockCharts contributor, would say, if you want to outperform the S&P 500, you have to own stocks that are outperforming the S&P 500. So with that, I want to wrap up today's show. Thanks so much for joining us every weekday here on the Final Bar after the close to look at today's trading from a technical perspective connected to the long-term trends. We had our first YouTube live Q&A this morning. I hope you'll join us next Thursday for it at 10:30-ish. If you subscribe to our YouTube channel, hit the little notification, you'll get a pop-up on your web browser on your cell phone when we're starting to take questions. Super interactive, super fun. Keep your questions and your feedback coming to us, won't you? The Final Bar at StockCharts.com is the best way to get a hold of us. Or during the show, just take a second right now, put a comment in the Q&A. We'll capture that and share it on a future broadcast. Want to thank my guest, Chris Brecher of Brecher Trading, for joining us today, sharing some charts on IPOs. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.